Welcome to my economics channel, where I love discussing the topic, but most importantly, I love to make it something fun and interesting to learn. And what I want to do today is actually continue a tradition which I've started on my channel, and that is responding to videos made by Economics Explained. I do this because he has such a large channel and has such a large reach. However, he makes some very amateur and very basic mistakes in economics, and I'm here to correct them. And so without further ado, I'm going to start on his video on the contraction in GDP in America. Let's get into it.
Finally, the last little bit of good news is that the second quarter results were actually better than expected. Given all of the turmoil in the world, this figure was actually expected to be about negative 36%, so it's better than it could have been. So, hopefully this has provided some much needed comfort for people that were anxious about all of these concerning headlines. Take a nice deep breath, relax a little, and let me tell you why we're all f***ed. This very well could be the end of growth as a given. The first concern that must be addressed is that demand has shrunk despite an increase in household income. This household income has been almost entirely driven by government stimulus.
Okay, so the first thing to point out here is that people are saving more, and yes, that is bad in a recession. However, it makes a great deal of sense for the private sector to save more when it comes to a recession. So when it comes to a recession, we understand that when we pull back our spending, we also pull back on other people's income. However, if we as an individual, we continue our spending during a recession, however, other people then take that money and they simply save it, then that's a problem for me, because all I'm doing is I'm fueling other people's savings, and there's no way for that money to then flow back into the economy as savings and investment and eventually come back to me. So think about it this way. Let's say you work in a business, a recession comes along and you're still spending your money like normal. In that case, you're contributing to other people's saving, they're panic saving during a recession. However, because they're not saving, that means money can't flow into your business. That means without that income, you're losing money, you're drawing upon your own savings or whatever other mechanisms you have to generate money, and then this is going to disadvantage you in the long run. So it makes sense for all of us as individuals to save more money. And so given that this is a bad thing to do in a recession, obviously, this is now where the government steps in. And this is exactly what Economics Explained meant when he said that government expenditures actually increased as a proportion of GDP, because the government went further into deficit to take the other side of the transaction, to then allow more people in the private sector to save more money, however, not harm incomes as much. Because instead of the private sector doing the spending, the government is doing the spending on our behalf. Therefore, when the economy returns back to normal, when we're allowed to resume our spending, the deficit can eventually be paid back. The point is that the deficit is meant to be temporary during the crisis. And so no, it's not as bad as Economics Explained says. Not simply for that reason. The forced shutdown is not a symptom of other things going wrong in the economy. If there are other things going wrong in the economy, they can exacerbate the effects of the shutdown. However, the shutdown happens on its own. It's there to save lives, and it's meant to be temporary, along with all the stimulus. And that ultimately is one of the reasons why stock markets around the world have still been going up. They've still been rallying because there's anticipation of what the future will bring. More specifically, a future where we're allowed to spend money again, we open up the economy, and we start reducing debts and deficits.
Which has not only made up for lost employment dollars, but actually surpassed it. These programs cannot last forever. They will either end up causing crippling debt or runaway inflation if genuine economic output does not at least keep up with the level of money creation.
Yep, that's the point. They're not meant to last forever. If they do, if these policies continue, then that's a really bad sign. However, these policies will not continue because the economy is shut down. They will continue only because there's other factors in the economy that have then prevented the recovery from taking place. However, no such obvious factors exist right now, and that is the main reason for governments going into this massive deficit right now.
The most obvious example of where everything is not going to be held equal is welfare. Most governments around the world have set end dates for specific relief packages that have been attempting to bolster their respective economies. In the United States, for example, the $600 per week supplementary federal unemployment benefit ended earlier on the 31st of July, with no specific replacement yet confirmed. This will very quickly turn the additional funds that people could have used for post-lockdown spending into emergency funds that people will need.
In regards to these stimulus programs ending, that's simply a political decision. That's not something that's been forced upon the government. It's simply the politics of the day playing out. And yes, this will hurt some people if these end early, but once again, this is not due to background issues in the economy. Now, of course, you could argue that politics is intertwined with the economy and that these background issues in the economy include politics, but I think that's getting a little bit into semantics. In this instance, I would separate economic issues from the issues in politics, especially in the US. If they want to stop these programs early, it's mostly just to bolster their own ratings. It's mostly to toe a party line or simply some other political measure, but it's not due to some inherent weakness that has been building up in the economy. Unless, of course, you think that the problems in the economy stem from the political issues happening in the US. I just happen to be more optimistic, and based on all of my extensive readings that I've done over the years, I think that this issue with Trump is going to be a small blip in the economy for the US, and indeed just for politics in the US as a whole. Even if he wins this November and serves another 4 years, I still think the effects of Trump will be minimal because I think the underlying institutions in the US are quite strong. But of course, I do recognize this is just my opinion.
This is all ignoring the problem of investment. Investment is the final component of GDP, and it fell by an unbelievable 49%. This means a few things. The first is that new businesses are not getting funded because, well, now is hardly the time to be picking promising new startups. Conversely, it also means that a lot of that extra cash is just sitting idle. Normally, if people save money, it's okay because financial institutions...
This is highly misleading. It's hard for money to quote unquote sit idle if your money is earning any sort of return. Anywhere you're putting your money, it does not matter where in the financial system your money is being stored. If your money is earning any sort of percentage return, even if that's 0.001%, it is impossible for your money to be quote unquote idle. The only possible way for your money to be idle is for you to literally have it as cash and stash it inside your house, because that way no one else is using your money. No one else has access to your money. The point here is that if your money is somewhere in the financial system, someone is using that money somewhere, somehow. The only possible way you can generate an interest rate return, regardless of how low that is because someone is using your money for some sort of project that will somewhere down the line generate some growth. It has to happen this way. And this ultimately is why you can receive a percentage return on your money. Someone is using that money. Even in a stalled economy like this, someone is using that money. Unless, as already mentioned, your money is literally cash under your bed.
Institutions can just use that money as the foundation for an investment strategy, be it writing loans or investing into other assets. The sheer drop in savings indicates that not even banks, the ones that are collecting all of this extra cash, are compelled to put it into use in any way in the economy.
So once again, just to point out, if your money is in the bank, I guarantee you the bank is doing something with your money. Even if it is just investing in government bonds or treasuries, those yield a percentage return that the government then pays that interest to that bank. The only reason the government sells that bond or that treasury in the first place is because it's raising money, and the government is doing that specifically to then be able to spend more money. So even if the bank is not investing your money somewhere in the private sector and all it's doing is buying bonds and treasuries, well then the government is getting your money and the government is doing the spending for the private sector. It's another matter entirely if you agree with how the money is being used, but what is not in dispute is that your money is not idle in the sense that is implied by Economics Explained.
In turn, this means that there is a lot of cash sitting idle, which sounds like a good problem to have, but it is a problem. While this cash is not being used for anything, it may as well not exist. But if...
Just to hammer this point home, I guess I might be nitpicking here. However, the only money that may as well not exist is if you take your money out as cash and store it under your bed. If it was the case that you took money out of the financial system and you set that money alight, we can simply print that money back into existence with no ill effects whatsoever. This is because money is not a resource in and of itself. If we were in a gold-based system, then yes, it would be a problem if someone took some gold out of the economy and literally threw it away, hid it somewhere where other people could not find it.
But if it suddenly falls into widespread circulation very quickly, it will cause inflation. Let's take a wine.
So it could cause inflation, not necessarily will cause inflation. The point here is that we're not spending money simply because we're not allowed to spend money. So when the economy opens back up, there'll be more things to be able to spend your money on. And assuming there isn't way too much money in the economy, which I don't think there is right now, we're simply going to go close to where we were before in terms of how much money we were spending and what there is to buy. The point is, there's many things we're not allowed to buy now, so we're saving up our money. However, when aggregate supply, when the amount of things we can buy shoots up again, then we'll start spending our money, ideally proportionally. This is not to say that there are no legitimate fears of inflation. However, I do think some of them are overblown, and it's not something that's necessarily going to happen very quickly.
If and when everything goes back to normal, they might finally decide to book that weekend away and find that unfortunately, every other yuppie on the West Coast had the same idea. The bed and breakfast is booked out for weeks, and the only available nights that they have are at a steep premium due to the surge in cashed up demand and the fall in supply of all their competitors going out of business. Take this over.
And this is exactly why the government programs predominantly targeted businesses. We want businesses to be dormant while the crisis plays out, and then when we can open the economy back up, businesses then open back up together. And we don't get a mismatch between aggregate demand, or simply all the money in the economy, and aggregate supply, or simply all the things that we can buy. So it is entirely possible that there are going to be some businesses that do not open back up immediately. However, I think the majority of businesses, even the ones that will close down, new businesses are going to pop up in their place. They'll replace the lost businesses from before, aggregate supply will go up, and prices will equilibrate. This doesn't mean that there won't be a mismatch for a little while, but it will not cause hyperinflation, and I don't think it will cause much inflation at all. I think that people seeing higher prices will recognize that other businesses will move up in the place of the businesses that have closed down. Yes, this will cause some pain for people who will want to spend money but can't. However, those people are in the same situation that most of us are in right now. Right now, we can't spend money, and we recognize that the economy will eventually open back up. And if it happens that some businesses, when they open up, they do hike their prices, most people will wait for more businesses to open back up because they recognize now that the economy is open again and that there's no deep structural issues preventing other businesses from opening up again. We didn't suddenly lose a bunch of resources. We didn't suddenly lose a bunch of buildings or any other capacity in the economy. We recognize that it's temporary in nature. So I don't think inflation will come just from this side of the economy opening back up a little bit too slowly.
Now, in the same vein, if and when everything goes back to normal, institutions and wealthy individuals might be more tempted to go out and invest again, and they will find that, hey, only a few investment-worthy businesses exist anymore, so they will drive up the price of what might have been a reasonable investment to such a level that it no longer is. For example, Tesla is an attractive investment because it is a company championing genuine innovation and adding value to an otherwise stagnant market. It might have had great investment potential at $400 per share.
So the point here is that yes, there is some empirical work that says, especially during the period of the Great Moderation, or simply the decade before the global financial crisis, that the Fed had interest rates far too low, and that this then caused investment to happen in companies that otherwise would not have happened. It is entirely possible that this will happen going into the future after the crisis ends. However, how strong these aggregate effects will be is another matter. If it is the case that the economy improves so quickly that people can suddenly start bidding up these investments in the economy, then it is more than likely that interest rates will start rising. Once interest rates start rising, we might see a die-off of these so-called zombie companies. And then it will become more expensive to borrow money as well. So then we're going to see a gradual slowdown in activity, and then ideally we get a new equilibrium. People simply investing a lot of money into companies is not necessarily a bad thing in and of itself. It depends what the company does with the money. People investing a disproportionate amount of money into the economy or simply into companies after the crisis ends and after everything opens back up could simply hasten the recovery that's going to come.
We don't want to pick on Tesla here because nobody can predict the future regarding any individual stock. But again, in this bigger picture, this effect will happen everywhere. Institutions and individuals will buy into mediocre investments because they have to. They have too much cash at their disposal and they don't want to hold on to it due to fears of inflation.
So once again, to reiterate, the reason people have all of this cash is because they're not allowed to spend it. People don't want to hold on to this cash, but they're doing it during a crisis, which makes sense. But when the economy opens back up again, people will start spending more money once again, like they were previously. Obviously not exactly to the same level. It's going to be a while before we return to the growth path that we were on. However, people will be spending their money because we're allowed to spend more money. It's not necessarily all going to suddenly pile on into investments. If money starts pouring into businesses and they're growing their businesses or new businesses are starting and there's no one paying money into these companies, then on the macro level, these would be terrible investments. But there's no point in those businesses taking that money and spending it on expanding business if there's nobody out there spending money. So one of the main ways we're going to get inflation is if people start spending money over and above what they were before once the economy returns to normal, if people continue to bid up prices, or indeed if government investments continue. But simply piling money on into businesses is not going to be inflationary in and of itself. And money piling on into businesses can only happen if people are on the other end spending money into businesses. It's not just a one-way street of investment going into businesses. Something is happening with that investment. And this ties in exactly to what I was saying before, with your money being in the financial industry. Not to beat a dead horse at this point, but if your money is in the financial industry, someone somewhere down the line is using your money. The only reason they're using that money is because they're using it for something that makes sense, for something that's going to grow the economy, for something where they're going to provide a service that someone down the line will eventually buy. If no one buys that service, then it was a poor investment in the first place. And yes, some individual businesses will make some poor investments. However, investment in the aggregate is going to be a good thing. It's going to grow the amount of goods and services we can buy and ultimately make us better off. Because otherwise, what's the point?
This problem is all going to get worse because average people won't have enough money and rich institutions will have too much money. What else is new? Well, the big difference this time is the centre of the devastation. The 2008 subprime mortgage crisis was led by malinvestments into mortgage-backed securities that were ultimately worthless and heavily impacted financial institutions. This malinvestment...
The mortgage-backed securities proved to be worthless when there was a run on the shadow banking sector, the institutions that were holding these mortgage-backed securities and using them as money. However, that happened when there was a correction in house prices in the US, and then some big institutions in the US and abroad wanted to trade their mortgage-backed securities for money. This is not normally a problem, and this is something that happens on a daily basis. The problem was that it happened all at once, and this caused a run on the shadow banking sector, which obviously didn't have enough money to then pay out the people who had the mortgage-backed securities, and this eventually led into the banking system, which proved to be the ultimate backstops of these shadow banks. And then the Fed had to get involved, and then eventually we got the crisis.
The economic fallout of 2020 will likely happen the same way, but this time it started on Main Street. The shutdown forced people out of their jobs, which prompted massive stimulus, which led to easy access to cash through a lot of government support. This will lead to malinvestment, which will lead to market crashes.
I take exception with the will part. It might lead to malinvestment. It might lead to some businesses getting money that otherwise would not have. However, the money being invested in the economy in the aggregate will not be as big an issue as is being painted here. It goes back to what I was saying before. It is not deep structural issues that caused the shutdown in the economy. They may have exacerbated the effects of shutting down the economy, but the point is that shutting down the economy was a deliberate act. We knew what would happen when we shut down the economy. It is very, very likely that people investing money right now are going to do it in businesses that do not deserve the money. However, in the aggregate, when everything opens back up, nothing else in the economy has changed. The economy is as it was previously. However, it is being devastated by the fact that we decided to shut down the economy on purpose. This is not to say that it's impossible, that there won't be other effects that will come up as a result of us reopening the economy. But the thing is, there is no alternative. There was no deep-seated issue with capitalism or some other issue in the economy that forced us to shut down the economy. If there are any other effects with the economy that come up after that, we will then deal with it with the new resources that we have at our disposal, specifically because we reopen the economy.
Will a regular recession follow this? Well, who knows? Again, nobody has a crystal ball, but the thousands of businesses only propped up by generous government support, relief packages coming to an end, record unemployment, mountains of idle cash, and genuine losses in productive potential are not great signs.
And so once again, I want to point out this is utter rubbish. It's really in the language. It's when he lumps together businesses saying that they're being propped up by the government deficit. Well, duh, yes, that is exactly the point. We want these businesses to be around. We want these businesses to essentially be on ice, if you will, so that when the economy opens back up, these businesses can start trading again, and they can do it without delay. If there are businesses that are permanently closed down now, it's going to be a while before new businesses replace them. It could be a few months or it could be a few years. These businesses, which have been quote unquote propped up, they can start trading immediately. Some might even be able to trade on the next day after reopening is announced. So it's not a matter of there being structural issues in the economy that have caused a shutdown and suddenly the big bad government is propping up these failing or zombie businesses. So the government going further into deficit and quote unquote propping up these businesses, it's doing exactly what it's supposed to do. That is the exact effect these deficits, this government support is supposed to have. This is especially what I take issue with in this video. It is far too simple a narrative being spun about the woes in the economy. So I have to hammer this point again. The current woes in the economy are being caused precisely because we are deciding to shut down the economy on purpose. And we do this for hopefully a short period of time so that when we reopen, businesses are ready to reopen and we can resume going back to the way we were before.
Business debt were piled up over 10 years of record low interest rates, and the bill had to come in eventually. Hindsight is obviously a luxury, but this problem really needed to be addressed 5 years ago. When the going is good, low interest rates are a dangerous tap to keep on. It means that people and institutions are tempted to borrow, or rather overborrow, to buy that new house or car or...
So this is actually an empirical matter. And because of the power of the Fed or other central banks around the world, and owing of course to all of the actions the central banks have taken since the 2008 crisis, people imagine that central banks are these all-powerful things that can control the economy, when it's simply not the case. It is the fact that the economy acts first, and that we have what is called a natural interest rate in the economy, which you can think of acts as a price between savings and investment. If the natural interest rate in the economy is low, it's because that's what the economy needs. It needs to have those low interest rates because of issues in the economy. If the natural interest rate in the economy is quite high, it's because people in the economy feel that there's excess mania in the economy and that we actually need to have high interest rates to rein in certain investments, to rein in spending, and ultimately rein in the economy and prepare it for a softer landing on the other side. The point here is that central banks don't control the rate of interest. What they do is they have to listen to the market and then they have to set an appropriate rate of interest. And this is exactly what the central banks spend a lot of time doing and researching. What is the natural rate of interest in the economy? If the natural rate of interest in the economy is quite low, however, the central bank sets rates too high, that's going to cause massive issues in the economy. The converse is also true. If the natural rate of interest in the economy is too high, however, the central bank sets the interest rate too low, that will then also cause issues in the economy. And the former is exactly what people accuse of the Fed during the crisis. See, what was happening was the Fed was lowering interest rates. However, these interest rates were still too high as compared to market interest rates at the time. So even as the Federal Reserve was lowering interest rates after the crisis hit, they were still too high, and it turned out that money was actually too tight. The Fed was actually tightening monetary policy during the crisis, and this helped to exacerbate the crisis. And so this story is far more interesting and compelling than what is being presented here in this video by Economics Explained. He presents far too simple a story that firstly has no basis in reality, but is also just not as interesting as actual reality itself. The story is being told in almost a hand-wavy fashion. Because he's not going into detail in this video, he's missing out on all of the interesting things. And that's exactly why I'm making this video. And that's exactly why this video is so long and why I'm going into so much depth. Because this depth that I've been going into, not to toot my own horn, but this depth is exactly what makes the economy so much more interesting than what is being presented in this video. This very simple story that, yes, on the one hand is fairly easy to understand, but on the other is simply wrong, or if it's not wrong, it leads you down to the wrong impression about the economy.
This flies directly contrary to what is supposed to be the role of an investor in an economy, which is to use their knowledge and intuition to effectively allocate capital towards productive businesses or promising ventures. Investors in modern economies are rarely rewarded for being savvy or prudent. Their returns are almost exclusively determined by how much they are investing. On top of this, investments normally attract lower taxes or at least accommodate more loopholes than regular earned income. A popular, albeit controversial solution is just to make investing difficult.
And so this point of the video, even though we're near the end, is what annoyed me the most and is actually one of the driving factors behind me making this video in the first place. If investing should be difficult, imagine yourself, how are you going to invest for the future? The only way you can save for retirement if you're in your 20s, 30s, 40s, or even 50s is because you're earning a percentage return. That percentage return is investment into the economy. If it is difficult to invest into the economy, it's also difficult to invest for the future, for your future self, or for when you grow old and you have to live off your investments. So investing is quote unquote easy in an environment specifically because the environment needs investment to be easy. If the natural rate of interest is low, that is specifically because that's exactly what the economy needs. If investment is easy, it's also easy for you to invest for your future. If investment is hard, it's also hard for you to invest for your future. If we decide to make investments difficult on a whim, we're also going to make it difficult for people growing up today to save, to invest for their future. Remember, the only way you can invest for your future, the only way you can get to an old age and you can retire is because of your investments. Your investments that earn a percentage return because they participated somewhere in the economy to help grow the economy. Regardless of how you're investing, whether you're doing it yourself or someone's doing it on your behalf, they're doing it into the economy. Someone is using that money to help grow the economy, and that is how you get a return. It's easy because other people can easily use your money to then get a return. If it turns out that investment should be difficult, this is precisely a time when the economy doesn't need aggregate investment to increase. It will be at a boom phase for the economy, and that is precisely when we don't want an overheating economy to continue. That is when we want higher interest rates, and that is when we want investing to quote unquote be harder. And so I really hope I've driven home the point that the story being presented in this video is far too simple, and it gives a wrong impression about the economy and how it works. And ultimately, of course, comes up with the wrong conclusion.
People should not necessarily be able to set and forget a portfolio of Vanguard ETFs and live the rest of their life off passive income and capital gains. These investors don't contribute towards productivity, but they do feed off it. Now, in the interest of full
So once again, this is utter nonsense. If you're investing your money, I guarantee you someone somewhere down the line is using your money, and the only reason they're taking that money is because they're growing the economy somewhere. You might disagree with the form that someone is using that money, but ultimately something new is being created in the economy, and the only way we have the present economy is because people in the past invested money, companies use that money, and we have the growth that we enjoy today.
Wealthy investors blindly throwing money into dollar cost average portfolios comprised of the same inert assets or established companies that everybody else is investing in, potentially less great. Again, this is a highly controversial idea, but one that deserves discussion. Let us know how you would handle earned versus unearned income in a comment below, and we will discuss the most upvoted answer on this week's Q&A session.
The only way you can live off passive investments is if those investments are returning something to you, that percentage return. That percentage return can only come from new growth in the economy. If you're passively investing money and you can live off that, and it turns out that all that's happening is a billionaire is paying that interest to you, that then obviously is not causing growth in the economy. That's just a transfer from the billionaire to you. However, I can guarantee you that's not happening. Even billionaires are investing their money. They're investing their money specifically for new growth to happen in the economy, for them to get income over and above what they have now. The only way they can do that is from new growth that's happening in the economy. No matter what passive investment under the sun you choose, it can only continue to give you percentage returns because it's been invested somewhere in the economy, it's growing the economy, and then you're getting a slice of that new growth that is happening. And so yeah, thank you for sticking with me through this incredibly long video. I do agree that there are a lot of nitpicks in this video, but I do think they're crucial to understanding how the economy actually works and to understand that the economy is far more interesting than what is being presented by Economics Explained in this video, and indeed by a lot of his videos. So thank you for watching. Subscribe, rate, and share all the good stuff. It definitely helps my channel, and I'll see you guys next time.